Okay, so let's begin. So it's a very exciting topic, life insurance and disability and health. So we'll first talk about all three, right? Understand the concept and then discuss, right, life insurance. So let me open a Google Sheet for that. So this is life insurance notes. So first let us discuss the concept. Then we'll discuss how to buy it, or before how to buy, who needs it. Okay, then how to buy. Okay, before how to buy we need to discuss types, so we'll discuss types and how to buy, and finally, yeah, so those 4 points will focus on the concept of life insurance, who needs it, right, types of life insurance you need to understand, and how to buy life insurance in an easy way. Okay, so let me
Sorry
share.
to interrupt. You're not sharing your screen.
Yeah, thanks for that. Like I just realized. Okay, so I'm sharing my screen now. So we are going to discuss four things practically first and then go over the PowerPoints. So first thing, what is the concept of life insurance? Life insurance is for your family. So let's say there is a person A, okay, and he has a family that is dependent on him. Okay, now that person A will have a certain income that family will depend on. From that income they will like do some living expenses, they will try to achieve their goals like education of kids, etc, etc. So a person, if he has income and if the family depends on that income, then there is a risk that if something happens to that person A, the income goes away, then family will have financial difficulties. So if a person has income and the family depends on that income, for that family there is a risk that if something happens to that person, they will have financial difficulties, right? So the risk that the family face is financial difficulties if something happens to person A. Okay, risk is they will have some financial difficulties if something happens to person A. Now how do you do with this risk? What can you do with this risk? So one thing you can always do is have enough assets, so enough assets that family can depend on. So assets are your investments. Okay, so you can start building enough investments that if something happens to you as a person, then that assets could be used by the family to derive income or to achieve their financial goals, right? But it takes a long time to create assets that are enough for the family to sustain. Like generally some are born wealthy, but not all of us are fortunate like that. So how do we deal with this risk without creating asset? That is self insurance is creating assets. Not all of us can do that, right? And not in the given time, right? Not in a very short time. So what do people do? People get insurance, especially life insurance. So what is life insurance? In a life insurance policy, you as a person A pay small premium to a life insurance company. Against that premium, the life insurance company decides or agrees to pay to the family if something goes wrong. So once again, a person A, right? So person A there is family, and there is life insurance company. So the person A, yeah, I will share the link of the previous sheet. Okay, there is a question, so I was just answering that. So there is a person A who pays small premium to a life insurance company. Okay, life insurance company takes that premium and agrees to pay sum assured agrees to pay sum assured to the family, but only if something happens to person A. So this is the concept of life insurance. You as a person pay small premiums, the company accepts those premiums. Once the company accepts those premiums, they agree to cover you, right, in case of something happens to you, and they pay out a big financial benefit to the family. So this is the basic concept of insurance, life insurance. Okay, now who needs it? Not all of us need life insurance. It is important to understand, not all of us need life insurance. So people who are single, who have no dependents, they don't need, no insurance is required, no life insurance is needed in that case. Okay, then if you have enough wealth, if you have enough wealth that could be used by the family in case something happens to you, then also you don't need life insurance. But if those things are not there, there are people who depend on you. Maybe it's a spouse, maybe it's the kids that depend on you. In that case, you need life insurance. So if you have dependents, then most certainly you need life insurance. Okay, most certainly you need life insurance. Okay, now there are different types of life insurance. So the first type, the basic type, is term insurance. So term insurance, in the easiest way to understand it, it is pure life insurance. So term insurance is pure life insurance, doesn't have anything else with it. Okay, so you pay a small premium, you get covered for the sum assured. If something happens to that person who is buying life insurance, the insurance company will pay. Okay, term premiums are cheapest form of insurance, and they are for limited time. They are for limited time. Then there is whole life insurance. Okay, also called as permanent insurance. This is a pure form of insurance again. It's not cheap because it covers your whole life and it pays sum assured. So it's kind of a permanent insurance. We'll discuss this concept more in the slides, but it basically covers your entire life. But the key point is you don't need insurance for your entire life. You generally need insurance when you have kids that are dependent on you and when you don't have enough retirement savings that you have built up. So especially people in the 30s, right, who are just starting new families, they need the insurance need for them is the highest. But as you start growing old, right, let's say 40s and 50s and 60s, then by the time you're in your 60s, your mortgage is most likely paid off. Then your kids are not dependent on you financially, they are in their own lives, right? And your spouse has, you should have enough wealth built to take care of yourself and your spouse. So in that case, the insurance needs are very low. So rather than whole life, you could use term insurance certainly longer term insurance products to cover your most immediate needs in a cheaper way. There is also universal life. That's a product that has insurance plus investments. Okay, that has insurance plus investments, right? It is very expensive. Okay, but it pays money after certain time, even if the person survives, because it has investment component to it. So it will pay money after certain time, even if the person survives. So there are basically three types of policies. Term insurance policies, it covers you for a limited duration, pure insurance. You pay premium, you get coverage, something happens, the company pays. Whole life policy, right, it covers you for the whole life that you are there. Okay. Universal life, combination of insurance and investments. Investments could be in safe products like debt products, or it could be in stock markets too. Very expensive, pays money even if you're alive. Now, how to buy insurance? Very easy to do, right? There are a lot of online platforms these days. Okay, so the platform that I will show is TD. It's not in like a recommendation or anything, but I'll just show you because it's easy. Okay, so you can say check my price. So you have to put in date of your birth. Okay, you have to put in your sex. Generally, males have higher life insurance premiums, right? The cost of insuring a male is higher. Okay, yeah, people's jobs can offer plans, or companies as well. Yes, people's jobs can offer in life insurance, but it's most certainly not enough. Most companies, oh, that's a very good question. Most companies do offer some life insurance, but it is generally limited to three times of your income. So let's say your income is $100,000. Most likely they will cover you up to maximum three times of your income, that is 300,000. But that might not be enough for your family. So you might have to take additional insurance in spite of that. Okay, but it's a good point. Some insurances do, some most companies do provide some form of life insurance. So you have to put in sex, let's say male. If you are if you have smoking habits, they will charge you extra. And never lie on insurance policies, because if they find out, right, that you have lied, they will deny you the claim. So let's say we don't smoke. Okay, you're not any of these. Alberta is our province, and you can see my price. As simple as that. So 20-year term insurance is for $53 per month, right? And how much is the policy? $675,000. That's the life insurance sum assured. Sum assured means if something happens to the person who is buying this insurance, the company will pay this much. Okay, 675 to $76,000. Insurance proceeds are tax free in Canada, so no need to pay any taxes on that. Okay, you can change the insurance amount. Let's say you want $1 million of insurance, so the premiums will change, but it is quite cheap, $77 a month, and you get $1 million of sum assured, right? That takes care of your family, and right, they pay only if something happens to you, right? This is an example of a whole life policy. So 100-year term policy covers your whole life, so insurance premiums are higher, right? And this is a 20-year term life. Generally, when you start your family and the kids are young, then 20 years is enough time for you, because once they reach like adulthood, they might not be that much financially dependent on you. So good idea to buy combinations of terms and like set your price. Very easy to do. If you say apply now, you go through some hoops, fill in your details, and that's it. You're done. You're set. Any questions yet? Okay. Now, how much to buy? That is a very important consideration. So the book says 10 times of your annual income, right? That is the income approach. But there is a good way to do it. So there is this concept called as FIRE, financial independence, retire early. So based on that, if you can, right, have a sum assured. So I'll give you the formula for that. So insurance needed equals to 25 times your yearly spending as a family, okay, which includes savings for different goals, okay, 25 times yearly family spending, which includes all the goals that you are saving for as a family, okay, minus assets you have, or investments you have, rather than asset, investments you have for insurance purpose that you can allocate to your family. So this is a quick and dirty way to calculate how much insurance you need. So let's say you have a family that spends around $70,000, right, annually on different expenses and also saving goals. So that comes to around 1.7 million. Okay, 1.7 million. You subtract from that the investments you have. So let's say you have $100,000 invested in your RRSPs, in your different instruments. So that will give you 1.6 million. So a family who spends $70,000, right, as a unit will need around 1.65 million insurance to cover themselves for rest of their lives. So if you change this to 1.6 million, so your premium, your cost of insurance will be $100 as a family unit. That could be divided into equal parts, right? This premium. So this is one quick and dirty way to do it. This is based on the FIRE principle, financial independence, retire early. Okay. So this is the formula that you can use. 25 times your yearly income, including different saving goals you have, minus investments you already have. So as you build your investments up, right, the number will keep on going down. The insurance you need will keep on going down. Okay. Term insurance is a quick and easy way to deal with your risk. Any questions? So we covered the concept, we covered who needs it, we covered types, we covered how to buy, and we covered how much to buy. Okay. Next important concept is disability insurance. Now, disability is statistically more probable than like life event, right? Than death. So it is much more probable that a person has a disability, some kind of disability, which restricts them from work rather than death. So people generally get life insurance because people talk about it a lot, but very few people get disability insurance. But it is equally important. So what is disability insurance? They pay you monthly insurance amount in case of total or partial disability. They pay you monthly amount in case of total or partial disability. Also remember, for certain time after disability happens, a person can use EI and CPP benefits, right, as disability income. But after that point, the payments will stop. So it is important to note that a person should always look for disability insurance. You can either buy it along with life insurance policy as a rider is add-ons that you can put to an life insurance policy, or you can buy it separately. Disability insurance pays you a monthly pension if some kind of disability happens to you. Okay, again, important point, you can buy it as a rider. Along riders are additional things that you can add into your life insurance policy. So you can add it as a separate rider, or you can buy a new policy, new disability policy. Okay, next you can also add a critical illness rider to your life insurance policy. Critical illness rider pays you cash amount if person if a person is diagnosed with critical illness. So if a person gets diagnosed with certain critical illness, right, they pay you cash amounts. For example, cancer is a big thing that people get it for. So if a person is diagnosed with cancer, then the insurance company will pay $50,000. Okay, that's the general rider that they get. So that money can be used for treatments and stuff. Okay, then there is finally extended health benefits that are provided in Canada. Extended health benefits generally covers pharmacare, physios and stuff, and dental. Three important things that they cover. They cover pharmacy drugs. It's not complete coverage. They pay you certain amount, right? Physios and dental. So extended health is mostly provided by your employer if you're working with them. So check out with your employer. But once you retire, you have to buy it separately. So your costs, you will incur some cost to get extended health benefits. So along with life insurance as a concept, you have to also think about disability insurance, which is very critical. Okay, disability insurance pays a person in case of disability, and it is a monthly payment. So it is a kind of a way to replace your wages or salary. Critical illness rider, get diagnosed with critical illness, the insurance company will pay you cash amount, a big lump sum cash amount to deal with that critical illness. Extended health benefit, generally available from your employer, covers pharmacare, that is prescription medicines. They cover cost of that. Physios and chiropractors and massage therapists, they have some X number of things free. And finally, they cover dental. If you are a retired person, you have to buy this separately because the employer would not be there to provide it. Any questions? Okay, so let's discuss the PowerPoints. Okay, So, this is chapter 9. We are going to discuss life, health, and disability insurance. So, we'll define what life insurance is, describes its purpose and its principles. We will determine our life insurance needs, distinguish between type of insurance policies, and analyze various types of life insurance. Select important provisions that are there in life insurance contracts. We'll try to understand the basics of it, create a plan to buy life insurance policy, define health insurance and explain its importance in financial planning, and recognize the need for disability income insurance. Then understand the value of supplemental life insurance, health insurance. So, what is life insurance? Life insurance is obtained by purchasing a policy with a life insurance company, promising to pay a lump sum amount to the beneficiary, that is the family, at the time of insured's death or sometimes while they are still alive. Especially if it is a universal life policy, then you can get paid even when you're alive. In some policies, money is paid to the policyholder, the insured, if he or she is still alive at a future date. So, this is important. Some policies pay the policyholders the investment part of them. Okay, so it's a life insurance policy that has combination of insurance plus investment. So that investment part keeps on growing and that is paid to the policyholders. Companies make promise to pay in exchange for payment of premium. What is the purpose of life insurance? The purpose of life insurance is to protect someone who depends on you from financial loss related to your death. Proceeds may be used to pay off a home mortgage or other debts at the time, provide lump sum payments through an endowment to children when they reach specific age, especially for their education and stuff, provide an education or income for your children, make charitable bequests upon your death, provide a retirement income. Okay, provide a retirement income to especially your spouse. That could be one of the purpose of life insurance. The proceeds can also be used to pay off estate debts at the time of death, provide education income for survivors, make charitable donations, accumulate savings. Life insurance is one of the few ways to provide liquidity at the time of death. What is the principle of life insurance? So principle of life insurance cost depends on mortality table. Mortality table provides odds of a person dying based on age and sex. So as the person ages, the probability of the person dying increases. So life insurance cost will go up as you age. So it's a good idea the moment you start a family, right? Buy an life insurance because then you're young. So that cost of insurance will be lower. Your premium is based on your life expectancy and the projections for payout for the person who die. They are adjustable for factors that increase or decrease an individual risk and various administration fees for the companies. So they are adjustable for various factors that increase or decrease. Like example, smoking increases the chance of death. So if a person is a smoker, then the cost of insurance will be higher. So they have given some examples. So probability of death goes up as you age. Okay, so this is the probability of death. Probability of death actually goes up as a person ages. So there is a 5% probability that a person who is 80-year-old, right, who is a Canadian male, dies. But there is only a 1% probability that a person that is 65-year-old actually has a event of death. Okay, so do you need life insurance? So important questions to ask yourself. Do you have people you need to protect financially? If answer is yes, you need life insurance. Do you have a partner who works, right? Then the insurance need will be lower, but still you will need some insurance. Determining your life insurance objectives. How much money do you want to leave your dependent should something happen to you? That is an important question to ask yourself. When you retire, what income do you need? how much will you able to pay for your insurance program? That is also important. Sometimes you might need higher insurance, but your budgets are very constrained. So it is like 100 bucks max, that is what you can afford. So you buy the maximum insurance possible for that given money. How do you estimate? So there are different ways. One way we discuss based on the FIRE principle. The other way is typically you need 70% of your salary for 7 years while the family adjusts. So it's a simple formula. Whatever is your current income, so let's say it is 70,000. You multiply that by 7 and take 70% of it. Why it is 70%? Because 30% probably of your income you consume in taxes and of on yourself. So you don't need that. So you multiply it by 70% and you get the insurance need. This is a very crude method and that might not be enough for you. The family need method, it is a more thorough analysis. So it is more thorough than the first method because it also considers employer provided insurance, social security benefits, income and assets. So family need method is basically how much you have, that is point number A. So how much balance you have in bank accounts, how much investments you have, how much real estate you have, right? How much insurance is provided by your employer. You add all of that, that will give you a number. Okay, then you add what your dependents will need. So there will be certain expenses right away, like funeral and burial expenses, final income tax expense, estate probate and administration costs. So we'll discuss this in estate planning. But when you create a will, right, that has to be administered, so there are costs for that. Mortgage and loans that not covered by insurance, credit card debt, add all of this. Okay, this is your need. Plus you will need living expense for your family members. So 75% of family income into number of years the dependents will need it. You calculate that. Then you will need emergency fund, 3 to 6 months of income. Then for children's education you need certain amounts. Okay, so you add that up, right? So finally you have B is addition of all of this. So immediate expenses, right? Then living expenses for the family and goals of the family. So you add all three up, you get what your dependents might need, subtract A from that, that is what you have, and you get insurance needed. So this is a complex method. Easier method is the FIRE principle. Simply do 25 times your family expense including the savings for your goals. So that takes care of the goals, right? And then subtract the investments you have already. So that way you get a more easier method and more useful method. This is very time consuming and very detailed. Now, what are the different life insurance types? So we discussed term life insurance. Term life insurance is pure insurance. It is protection for a specified period of time. Example was in that life insurance policy, it is a 20-year term policy. It means it protects you for 20 years from the date of signing. So for 20 years, you pay $117 monthly and you are protected for 1.65 million. So if something happens, the family gets 1.65 million. Okay, for that 20-year. Once the policy gets over, you have to buy another insurance. Okay, so if you don't pay premiums, the coverage stops. There is a renewability option, means that at the end of the term, you can renew the policy without going through a medical checkup. But of course, you have to pay a higher premium because you would have aged by that time. So 20 years from now, you would have to pay higher premiums to get term insurance. Conversion option is there, which allows you to convert your policy from term to whole life without giving medical exams. Term to 100, this policy remains in effect up to the age of 100. The level premiums cost significantly less than permanent insurance. Now with decreasing term, this is another type of insurance policy, decreasing term insurance. Your premium stays the same, but the amount of coverage decreases as you age. So this is a special type of term insurance policy you can buy, whereby you pay the same premium. The premium doesn't change throughout your life, but the amount of insurance that they provide will keep on going down. Next is permanent life insurance. It is purchased to cover lifelong needs, includes financial expenses, supplementing a survivor's income, capital gains, or for providing dependent children. They have level premium, which means which remains the same over the lifetime of the policy. Higher premiums are paid in early years, which are held in the reserve to offset the increased cost in the later years. These policies have cash value against which you can borrow and stuff. So if you buy a permanent life policy, you can borrow against that. Example will be this, like TD 100-year term life is nothing but a permanent life policy, right? You have to pay very high premium. So for 1.65 million, the premium is $1,729, right? So the premium cost is very high as compared to 20-year term, but it covers you for next 100 years. Okay. Upon death, the face value of policy is paid out to the beneficiaries. Permanent life insurance has following variables. So it could be whole life policy. It pays specified premiums as long as you're alive. So you keep on paying premiums into the policy, right? It pays stipulated sum to beneficiaries upon death, has a cash value which is paid out if the policy is given up. Universal life policy, it combines term insurance and investments. You can pay variable premium amounts because insurance premiums are fixed, right? So there are two parts to the monthly premium you pay. Some part of it goes to the insurance, right? That is fixed. But that investment part, you can put more or put less depending on your budget. So it is kind of combining insurance and investments. Okay. Increased cash value reflects interest earned, guaranteed not to be less than a specified amount. So these are good tools for saving money. Okay. But doesn't pay much interest. Like the rate of growth is very low, and generally most of the times it is below inflation. So not that useful. People will try to sell you this a lot, right? Because the commissions on these products are amazing, but might not be suitable for everyone. Okay. It uses current interest rates and can be changed to reflect prevailing rate changes. The death benefits are flexible, right? And can change premium without changing coverage. Next is variable life policy. It's type of universal life again. The premiums are guaranteed. So the case value equals performance of investment funds or other index. Variable life policy means same thing, insurance plus investment, but those investments are not put in safe investments like universal life. They are put it in stock market. So whatever the stock market does, your final value will depend on that. Minimum death benefit is guaranteed, but it can increase, but there is risk of poor investment. Endowment life insurance, the coverage from beginning of the contract to maturity, guarantees payment of specified sum even if the insured is still alive. So these are different types, but basically three types. One is term insurance, pure insurance, limited time, right? Then permanent policy or whole life policy, right? You get coverage for your whole life. It's very expensive. Then finally, universal life or variable life, in which insurance and investments are combined. Next, any questions till now? Any questions so far? Next, consider the following factors when pricing life insurance premium. You need to check the cost of the amount of insurance you need. Your Because if insurance amount goes up, the premiums will go up. We saw that if you change the premium amounts, right? If it is $50,000, it's only $14. If you change it to, let's say, 500,000, okay, $47. If you change it to 10 million, it is $684. So as the insurance premium goes, as the insurance policy amount goes up, sum assured goes up, right? So does the premium. Your health class, so if you're not healthy, then the insurance premiums are higher. Your age, as your age increases, the insurance premium goes up. Your gender, females have lower insurance cost than males, okay, because females are generally have a lower mortality rate than men. So men, because of that, the insurance costs are higher. Marital status, that will also determine your insurance premium. Generally, like if you're married and stuff, the insurance costs are lower compared to a person who is single of the same thing. Then occupation, right, that also determines your insurance premium. If you are in a risky occupation which has a high mortality rate, right, the insurance cost will be higher. What you do for recreational activities, if you have some dangerous sports like, let's say, skydiving or something that you occasionally do, then the insurance premiums will be higher for those individuals. Okay, there are group life insurance policies. So term insurance is often provided by the employer. So employer will provide certain type of insurance policies. It's important to note, most of the time they are not enough to cover your risk. So they might be restricted to 3 times your annual income. That is what most group policies restrict you from. There is no physical required until you're with the employer, they provide you coverage. There is also credit life insurance. So debt is paid off if something happens to you. It protects the lender, not you. So the money is not paid to the family, the money is paid to the bank. Maybe it is credit card debt or mortgage debt that you can buy insurance on. Okay. Any questions so far? So let's look at various things and various policies. So for a whole life, period of coverage is your entire life. For a universal life policy also, which has insurance plus investment in it, your coverage is entire life. Term 200, up to the age 100, it covers you. Term policy covers you for that specified term in the contract. It is often renewable, but the cost will be higher. But it is not renewable beyond the age of 70 and 75. Premiums, for whole life, the premiums are guaranteed. They usually remain same. Universal life, the premiums are flexible, because if you want, you can invest more or you can invest less. Can be increased or decreased by the policyholder within certain limits. Term 200, the premiums are guaranteed. They usually remain level. Term policy also, the premiums are same throughout the term. But after the term gets over, the premiums will increase. They will change. Death benefit, in whole life, it is guaranteed in the contract. It remains same. Dividends may be used to enhance death benefit in participating policy. So if your policy has dividend component to it, then you might get paid extra. Universal life, the death benefits are flexible. They may increase or decrease according to fluctuations in cash value funds. You may have multiple insureds on the plan. Term 200, the death benefits are guaranteed in the contract, they remain level. Term policies, again, they are guaranteed in the contract. The death benefits are guaranteed in the contract. Cash value is If you do not want the policy, you can hand your policy and get some cash from the insurance company. So whole life policy has a cash value that is guaranteed in the contract. Universal, it is flexible. It depends on the investment returns, how the investments are doing. Okay. Term 200, the cash values are not there. Usually they are none. And term policy also, cash values are not there. So cash term policies only pay if the policy holder dies, does not pay, right, if you return the policy back. So dividends, it's important to understand. So dividends are paid if the insurance company does well. So dividends are generally paid in whole life policy if the insurance company is doing well. So you're a part of that company, so you get paid. Universal life also, the most policies are non-participating and do not pay dividends. They just pay investment income. Term policies don't pay any dividends. Term 200 as well as term. What are the advantages of permanent insurance? It provides protection for your entire lifetime if it is kept in force. Premium cost usually stays level regardless of age or health problems. Has cash value that can be borrowed, used to continue protection if the premiums are missed, or withdrawn if the policy is no longer required. Other non-forfeiture options allow policyholders various possibility of continuing coverage if the premiums are missed or discontinued. If the policy is participating, it receives dividend that can be taken in cash, left to accumulate at interest, or used to purchase additional insurance. It can be an endowment plan that pays out benefit at specific age. Term policy provides protection up to the age of 100 if it is kept in force. Premium cost usually stays level regardless of age or health problems. Premium cost is lower relative to the traditional permanent policies. Okay. So term policy, you keep it up to the age of 100. Term to 100 policy. Normal term policy, the one that we saw, 20-year term or 10-year term, suitable for short-term insurance need or specific liability such as a mortgage, provides more immediate protection because initially it is less expensive than permanent insurance. It can be converted to permanent insurance without medical evidence if it has convertibility option, often up to the ages of 65 to 70. What is disadvantage of a permanent policy? The initial cost may be too high for enough protection of your current needs, may be inefficient means of covering short-term needs. Cash values tend to be small in early years. You must hold the policy for a long time, say over 10 years, before cash values become sizable. So it grows very, very slow. Term 200 policies, usually no cash value and no or limited non-forfeiture values are there. Okay. Term policies also, it doesn't have any cash value. If you renew, the premiums will increase, because if you have a limited term, let's say 20 years, and you need insurance beyond that, so when you renew, the insurance cost will go up. If the premium is paid, the policy terminates after 30 days and may not be reinstated if the health is poor. Usually no cash value and no non-forfeiture options. Any questions so far? Okay. So how it works? Term insurance policy, if you are young, the insurance cost is low. But as you age, the insurance cost will go up. Permanent life insurance policy, it will be very costly in initial years, but as you grow older, the term policies will be costlier. Any questions? Now, what are the important provisions in a life insurance contract? So, you have to name your beneficiaries and contingent beneficiaries. It's very important. You have to clearly mention what are your main beneficiaries and what are your contingent beneficiaries. So, let's spend some time here. What is the main beneficiary? The person who the money goes to. So, let's say in my case, it's my spouse. So, if something happens to me, all the insurance policy money will go to my spouse. Then that spouse will be responsible for dealing with it. Now, contingent beneficiary is if something happens to that spouse along with me, then who should the money go to? So it could be your kids in form of a trust, right? Or it could be your siblings if you trust them enough, right? So all those things you have to plan out. Who is the main beneficiary? And after that, who is the contingent beneficiary? Length of grace period for late payments, usually it is 28 to 31 days, right? So if you do not pay a premium, they will give you 28 days to pay it back. If you don't pay, the insurance policy will stop. Reinstatement of lapse policy, if it is not being turned in for a cash, is possible. You must again qualify as an acceptable risk. So do not stop paying your insurance premiums. Non-forfeiture clause prevents the forfeiture of future benefits if you drop the policy. Okay. In insurance, there is also incontestability clause which stipulates that after a policy has been in effect for a period of time, the company cannot dispute its validity. So this is a like regulatory clause that has been put in. So if a certain time period has gone, the company cannot say that they cannot refuse to pay you. So this is an important thing to understand. The suicide clause says during the first 2 years, the insurance policy will not pay in case of suicides. After 2 years, they will pay the sum assured even in case of suicides. So, suicide clause during the first 2 years, death benefit equals to the amount of premium paid. So, they will just return you back your premiums, right? But they will not pay you the entire sum assured. There is automatic premium loan, which uses the cash value to pay the missed premium if you do not pay. Misstatement of age provision. So, will generally, if you misstate your age in the policy will pay you benefits based on the current, like correct age. So, if you let's say that you're 1 year younger, then they will readjust the premium to reflect that. If you have a policy that can be turned into cash, especially whole life or universal life, in that case, you can take a policy loan. That is, policy loan provisions allow you to borrow against the cash values in the policy. A rider to a policy. Rider is something that modifies or adds to a life insurance policy. So a rider to a policy modifies its coverage by adding or excluding conditions or by changing benefits. So there is waiver of premium disability benefit. So if something happens to the policy holder, like some kind of disability, then the insurance policy will continue, but they don't have to pay any premiums. This is a rider that you can add to the policy you're buying. If you add this rider to your policy, if something happens to you in case of disability and you are not able to pay the premiums, the life insurance policy will still continue. There is accidental death benefit which pays twice of the sum assured. So you can add this rider. So in case of accidental death, right, the sum assured will multiply by 2. There is guaranteed insurability option, which guaranteed insurability means in case of even bad health, when you go and renew your policy, if you have this rider, they have to renew your policy. They cannot deny you insurance. So you can add that rider. You can add terminal illness rider to your policy. So if you are diagnosed with terminal illness, they will pay you a lump sum amount. You can also buy a policy in a joint name, which is last to die. Okay. So what should you do? look at your present and future sources of income, savings, group life insurance, group annuities, and government benefits. Determine from whom to buy your policy. Examine both private and public sources. Look up the company's rating. Check agent and direct insurance versus brokers. So check from which you want to buy. Agents and direct, like direct, if you buy online, the cost is generally lower. If you go through an agent or a broker, the cost is usually higher. Okay, so when you choose an insurance agent, always try to answer these yes or no questions. So is your agent available when needed? Clients sometimes have problems that might need immediate answer, so yes and no, click it. Does your agent advise you to have a financial plan? Each part of the plan should be necessary to overall financial protection. So, is he recommending that you follow the financial plan? Does your agent pressure you? Because sometimes the sales tactics, like insurance industry has very high, like uh, premiums are very high, commissions is the right word for the agents. So if your insurance agent is pressuring you too much, right, he or she is going to get big commissions out of you. That's why they are doing it. So they should work for your best interest, not for their own best interest. So make sure they are not. So does your agent pressure you? You should be free to make your own decisions about your insurance coverage. Then does your agent keep up with changes in insurance field? Agents often attend special classes or study on their own so that they can serve their clients better. So is your agent knowledgeable? Is your agent happy to answer questions? Do they want you to know exactly what are you paying with an insurance policy? That is also important. So buying life insurance, whenever you're buying life insurance, compare policy cost, because through different companies, the cost is different. Companies' cost of doing business will impact. Return on their investment will impact the insurance cost. Mortality rates, feature policy that it contains, competition among companies, all of this will like change the cost of insurance. So it's important, very important, right, to generally shop around. Use interest adjusted index to compare policies. It takes into account the time value of money, helps you to make cost comparison amongst insurance policies. Any questions so far?
No, sir.
Okay. So next, what are the steps involved in obtaining a policy? So you submit application to a company, which is your personal information, type of policy and limit of coverage, right? You also submit medical history, right? They might want some medical examinations to be done. So you might have to submit both of that, right? Then you examine the policy. They will provide you a policy copy. Before you purchase, read every word of the contract, get full explanation of terms and provisions. After you purchase, you can cancel the policy within 10 days without penalty. Make copies for lawyers and beneficiaries. Okay. Choosing settlement options. Options are the choice for how you want the money to be paid out. There is lump sum payment, that is most common. So the family is paid lump sum amount. You can also structure the payment as installments rather than one lump sum. You can have limited installment plan in equal installments for specific number of years after your death. You can also have life income option. It provides payments to the beneficiary for their whole life. The proceeds left with the company, right, it pays interest to the beneficiaries. Switching policies, consumers lose millions because they don't hold cash life policies long enough or they purchase the wrong policy. Switch if benefits exceeds the cost of getting another physical and paying policy setup cost. Check if you're still insurable. Can you get all provisions you want? Okay. Next is health insurance. Now it's important to understand health insurance, right? We have provincial health insurance that covers our basic necessities. So if you fall sick, if some kind of surgery you want, most of the time the province is going to cover you 100% of the cost. We have socialized healthcare in Canada, so you don't have to pay for it, right? But apart from that basic insurance, you might need some add-ons. So most basic medical procedures are provided under the provincial government healthcare plans. Canadian needs supplemental health insurance though for semi-private and private hospital rooms, private nursing care, cosmetic surgeries, physician testimony in the court if you are in an accident or anything, prescription drugs, right, which is big, and vision and dental care, which are currently not covered by the provincial plan. They are planning for a universal dental care and a universal, right, dental care and pharma care universal, same way like we have provincial health care, but it's not there yet. So currently insurance is not available. Healthcare cost outside of Canada can be very high and may not be covered by the provincial plans. Okay, so who provides healthcare in Canada? So 60% of all health insurance is sold as group plans. That is, it is provided by the employer you're working with. It is employer sponsored. Employees may pay part of the cost, but mostly the cost of that is sponsored by the employer. It covers you and the immediate family. It seldom requires any medical. It doesn't require any medical. Individual health insurance, it covers one person or the whole family, can be tailored to your particular needs. So important to note, most health insurance extended plans are provided by the employer in Canada. Disability insurance, it protects your most valuable assets, your ability to earn an income. It provides payments to replace income when an insured person is unable to work due to some accident or illness. What is disability? Disability is defined as own occupation. That is, if you're not able to perform the duties of your normal occupation, full benefits are paid even if you return to work in another capacity. So if you have a disability policy that is own occupation oriented, so it will keep on paying you benefits even if you return back to work but not in the same profession, right? So if you start working part-time in some grocery shop, for example, but you are not able to do construction work that you used to do earlier, then it will still pay you benefits. There is other policy, regular occupation, that is your inability to perform the duties of your ordinary occupation, but in this case the benefits are reduced if you return to alternative occupation. Now, own occupation disability policies are very costly because they pay you no matter what. Even if you join part-time work, full-time work in something else, they will pay you if you cannot do the main profession, right? Regular occupation disability policies are lower in cost because they stop paying you the moment, or they reduce your payments the moment you start working somewhere else. Disability is defined as any occupation. Full benefits are paid only if you cannot perform the duties of any occupation for which your experience and education qualifies you. Total disability, you're unable to work at all, or partial disability. Benefits apply if you're able to work, but you have to reduce the workload. What are the different trade-offs that you have to make? So there are different disability insurance trade-off. So there is waiting or elimination period, right? The longer the waiting period, the lower the premium. Waiting period means, and generally you have to remember, when a person is diagnosed with disability, most of the time you can get certain benefits from the government. So EI, employment insurance, has some disability benefits, right, that you can claim. CPP has some disability benefits that you can claim, right? So for certain time the government is going to cover you, Beyond that, you need insurance. So if you include that wait time in your policy, that the insurance company doesn't pay you for the wait time, right, that the time for which the government is paying, then the policies will be cheaper. Duration of the benefits, for how long do you want the benefits to happen, that will determine the cost. Amount of benefits, accident and sickness coverage, and guaranteed renewability. So all these things, if they are there, that will determine the cost. What are the different sources of disability income? It is employer. Sometimes the employer pays you disability. It can be private. It can be public. Public is employment insurance, CPP plans, workers' compensation, short-term and long-term welfare. Okay, so you can use this like sheet to find out, right, for like sick leave or short term disability, how much amount is your employer going to pay. This is something that your employer pays. So how much, how long the employer is going to pay, and how much the employer is going to pay. Then if you have a group long term disability option, check that. Employment insurance, government programs, individual disability insurance. So calculate all of that and then find out, right, how much you need to get for disability. How do you determine your disability income insurance requirement? So determine the benefits from public and private sources first, then determine the shortfall based on 70 to 80% of your after tax income. That is what you should be having in cash. So 70 to 80% of after tax income is needed to at least survive. Consider waiting periods and benefits. Any questions? So once again, recap. Disability is, if something happens to you and you cannot work, then the disability insurance is going to pay you. You don't need to cover everything, because some part will be provided by your employer, some part will be provided by the government for certain time, beyond which you would need private insurance. Next is critical illness insurance. It provides money for care if you're diagnosed with a serious illness or a condition, example cancer, heart disease, or a stroke. It pays you while you're alive. It is a tax-free lump sum amount within 30 days of being diagnosed. Most serious illnesses are not only treatable but curable, but the cost will be very high. It can be used to pay off other debts or take time off work. Typical policy provisions include waiver of premiums or premiums refunded to beneficiaries upon death. So what is critical illness? If some kind of critical illness happens to you, right, example, you're diagnosed with cancer or some kind of like disease that is not treatable, then a lump sum amount, 50,000, 60,000, 100,000 will be paid to you. Okay. Also, after considering health and disability coverage available from the government, employer, and other policy, you may decide to seek further coverage. Dental expenses are not covered by the province, so you might get dental expense insurance. They pay you reimbursement of dental services and supplies. They encourages preventative dental care. You can also get vision care insurance. Okay. So health services insurance, prescription drugs, semi-private and private rooms, home care and nursing and other services of healthcare are not covered by the government plans. Travel insurance. So when you travel outside of Canada, then the insurance doesn't cover you, right? Like especially the provincial health insurance that we have, the free one we have. So hospital and medical expenses incurred outside of Canada are not covered, for which you have to get travel insurance. Accidental death or dismemberment insurance, right, also look into it. There is also long term care insurance, which provides day in day out care for long term illness or disability. There are major provisions in health insurance policy. There is eligibility based on age, marital status, and dependency. There are assigned benefits, how much benefits will be paid to you, right? There are limits to those benefits. For example, most insurance policies that you get from your employers will have limits. For example, X number of massages you can do and dollar amount that they pay for each massage. So if you go beyond that, you have to pay from pocket. There is co-payment, the amount the patient pays after deductible. Generally in pharma care it is there. Most insurance plans covers 80% of pharmacy cost. Rest is paid by the employer. There are also exclusions and limitations. There are coordination of benefits between you and your partner. You should consider that. There is guaranteed renewability option, and there is cancellation and termination. Okay. Now, certain health insurance policies reimburse you. That is, you spend first and they pay you back. There are certain policies that pay you that do direct billing. So consider which policy you have. There are also internal limits and aggregate limits. So internal limits specify maximum benefit for specific expenses, and aggregate policy limit like covers the total amount that you're spending. There are deductible and co-insurance. It affects the cost of policy, and there are also out-of-pocket limits. Now, healthcare is getting very costly in Canada, and like long wait times and stuff, because the spending that is required is very high. So example, we had this orange line as the plan for healthcare spending, but the current healthcare spending has gone up a lot. So we are like in 2019, before the pandemic happened, we were spending $264 billion in healthcare. That is $7,000 per year per person on healthcare, and it is 11% of our gross domestic product. After pandemic, the costs are even higher. So healthcare is very costly in Canada. Province wise, like if you see, certain provinces have very costly like healthcare, like spending. Certain provinces have lower. Generally, northern provinces spend a lot per person on healthcare. Okay, that completes insurance topic. So we'll take a 20-minute break. Once we are back, we'll start with fundamentals of investing. So we're going to do 2 chapters today. So insurance is over. We'll take a break. When we are back, we'll do fundamentals of investing.